Robobank India, Mumbai. Sir is an analyst responsible for Indian beverages sector with the FAR group and is involved in industry research, market studies, entry strategies, business plans, and transaction advisory. Prior to joining Robobank, Sir was a part of the Credit Suisse European Beverage Equity Research Team for about 5 years. In this role, Sir has worked on fundamental analysis of companies in European consumer staple sector and was actively involved in research. Sir is a member of the Institute of Chartered Accountants of India and is ranked within the top 50 on an all-India basis. Sir is also a CFA charter holder. I welcome you, sir, to share your knowledge and experience and enlighten us with your words. Sir.
I thank Dr. Singh and the Balaji Institute of Management for inviting me here and allowing me to interact with such a large young crowd. I remember my college days when I was sort of leaving the college. These are the golden years of your life, and you should sort of take every moment and enjoy every moment with the maximum possible extent, I believe. I would like to sort of focus this lecture basically on the equity research and little bit flavor to it, and possibly all of you in future might join or maybe might invest yourself in the equity stock market in any time in the life, and that should be sort of this lecture should at least somewhat help you out to do some sort of analysis while you invest. Not just going by the rumors and the insider trading information which gets circulated in the market. So I believe you will do you'll take something out of this sort of presentation. It's a slight introduction to the equity research valuation methodologies, and probably focusing on what an investment banker does. So I am basically a chartered accountant, All India rank holder in May 2004. Then started my career with Credit Suisse, which is an investment bank, and it's probably the top bank within the M&A and the investment banking space. And the focus of the bank has essentially been on mergers, acquisitions, capital raising, and broking. Whereas I shifted to Robobank last year, and I'm the analyst for the Indian beverages space. I am covering the beer, spirits, wine, and the non-alcoholic part of it, tea, coffee, and soft drinks. What an equity research analyst does. Would anybody have an idea? Somebody there, I believe. Yeah. 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 That's perfectly said, I think. Yeah. What's your name? Kiran Prakash. Yeah. That's a nice way of explaining what an equity research analyst does. Equity research analyst is a guy who sort of researches on fundamental values of a company and publishes and sort of helps the world understand what a company is and whether it is worth investing or not. If not, then why? If yes, then what are the sort of positives that company possesses? So it's a sort of an intermediary between the investors and the company. We'll start with equity research. Equities as an asset class. Equities were almost valued equal to the entire world's GDP in 2008, pre-crisis levels. So If you go by the valuation, the market value of the equities was about 58 billion US dollars, which was almost equal to world's total GDP of 60 billion US dollars pre-crisis. And then the crisis came in and the valuations got reduced. Otherwise, equities would have been sort of a asset class, which is more than the value of all the nation's income put together. Equities is considered as an asset class which is sort of inflation hedge, which acts as an inflation hedge. Because whenever a company sort of has its equities listed, it also sort of indicates the value it possesses. And the stock value is considered as an inflation hedge because the profits of the company also vary along with the inflation levels. It is high historical return thing which actually has sort of, the returns have been exceeding the bank average interest rates earned in the past. As I said, the valuation of the equities was even more than 58 billion US dollars in 2008. And then the crisis came, which obviously reduced the valuation to 40 billion US dollars. Why research is important? Research provides information to the market. It is sort of a mechanism wherein the investors are made aware of what the company's values are and how the valuations has been arrived at. So the general people go by names and they don't understand what is the value of the debt, what is the value of the business, how the business is going to progress in future, and how the markets are going to be 10 years down the line. But equity research analysts sort of act as an intermediary. They sort of delve into the information insights and then possibly present them in a way which helps investors understand how the asset valuations are done. So research analysts are sort of intermediaries, explained it again and again, and its focus has been sort of providing research to the institutional investors who are large in value. They invest probably $1 billion every year, and that value has been growing up year by year. So they invest essentially, they help the M&A, the mutual funds, the pension funds, and other sort of asset investors to invest the funds in the right companies at the right valuation. So the equities analysts are further classified as sell-side analysts or buy-side analysts. Sell-side analysts are those who work with the investment banks and they sell the research essentially to the investors. So based on their research report, the investors would invest. Whereas buy-side investors are different from sell-side investors. They usually have a mandate to invest their own funds, and they sort of help the portfolio managers to invest their own funds. So mutual funds would have a buy-side research analyst who reads multiple research and arrives at the conclusion, which then helps them to sort of invest the money of the investors. A research analyst on the sell side usually covers 7 to 12 stocks. He keeps tracks of what is happening in the market. He usually sort of acts with the subject companies. For example, I was the beverages analyst at Credit Suisse, whereas I used to interact with the 10 companies in the universe, top 10 probably in the world. For example, Diageo, Pernod Ricard, and Heineken, Carlsberg, likewise. So I used to interact with the institutional investor relations department of these companies, get insights of the information, attend the analyst conference calls, which were sort of a regular feature. Every quarter they used to sort of have a conference call wherein I used to go and attend those conference calls. So that was a large sort of work there. And then once you sort of interact with the guys there, with all the subject companies, you come, you do your research. Research is basically arriving at the buy, sell, or neutral ratings for the stock based on the valuation models which you have. The valuation models are complex sort of financial analysis tools which are used by analysts to arrive at the valuation. And then obviously recommend the recommendations to the investors. So how the sell side makes money? Meaning it's fine. you do some research, you sell it to the investors, but what is the sort of main profit motive behind keeping a sell-side investment analyst? Basically, the sell-side investment analyst usually sort of recommends to the investors who in turn trade with your firm. For example, Credit Suisse would have a sort of brokerage house who would brokerage entity who would sort of then in turn act and trades for the investors, and that is the way it earns money. So it acts as an intermediary between sales and trading department, wherein the trading and sales business generates the revenues obviously after the bank gets some brokerage. And the brokerage volumes are enormous. For example, Credit Suisse might have made some $3 billion in the single broking activity last year. Position of the buy-side research. Buy-side research analyst is different than what a sell-side research analyst does. So buy-side analyst is basically placed with the buy-side team which analyzes the stocks and recommends to the portfolio managers who are sort of highly skilled research analysts or promoted to that level, who take the decision of the funds to where to invest and all. So these are the sort of key people who invest the funds of all the large portfolio companies. Any questions so far? Yeah, that guy there. Yeah. Yeah. On the buy side as well as sell side, the methodologies doesn't change. Basically, you have DCF based valuation models. DCF is discounted cash flow technique, wherein you discount the future cash flows of the company and arrive at the sort of valuation, today's valuation. So the discount rates and all those things I'll come a little bit later, probably in the presentation, so if that helps. So DCF is one of the methods. There are other methods also, relative valuation methodologies, dividend discounting models and all those things. So which is sort of you might have undergone in the academics somewhere, probably the finance MBA guys mostly. Any other? Yeah, so this is an example of equity research report. Yeah? Sorry.
So when you are dealing in equity, it means you are dealing in some shares and all. There has to be, when you are on a buyer side or when you are on a sell side,
Yeah.
you need to build up a rapport or trust or faith, because you have several other options when you are giving when you are performing, like when you are giving some of the
Recommendations.
Yeah. So how do you develop that rapport or trust? Because unless until you that the investor won't be able to invest in your securities and all these things.
Exactly. So there are dedicated relationship managers or sell-side professionals who usually go and meet the investors on a regular basis, and they sort of deliver the research on time every day. Meaning once the quarterly results are announced, the investors usually would travel to their place and then probably meet them and then sort of explain them the thesis behind investing in certain stocks. So that is the way it operates. You usually keep in touch with all the multiple portfolio managers and the buy-side research analysts. That's the way. And there are sometimes the investment banking firms sort of have capital markets day, wherein all the investors and the companies are brought together, and the company is present to them. So that is a platform wherein the companies can interact with the investors. The idea why one should sort of invest in Britvic, and what is the theme of that stock. The other one is on Indian markets. They are initiating the coverage of the Indian FMCG sector. This one is again two stocks wherein you are sort of saying buy Pernod and Diageo today and Carlsberg tomorrow. So it does mean that the near-term outlook for Diageo and Pernod Ricard is good, whereas Carlsberg is better bet if you buy tomorrow, not today, because the near-term Meaning there are a variety of reasons why it would be that way. So, for example, Carlsberg has a exposure to Russia, which was sort of going into downturn recently, and whereas the other two players are sort of on a growth trajectory, wherein they are sort of growing at a very good pace. So again, some question answers, interactive thing. Who founded Wall Street Journal? Can anybody answer? Yeah, so I think I should answer that question. It was founded by Dow and Jones. Who is the Oracle of Omaha? That's right. Who answered that? Yeah. Clap for this guy. It's nice. What is the term alpha refers to in investment banking community? It's basically the excessive return which is generated over the safety return. What is Chinese wall? Anybody? A firm, if it deals with the mergers, acquisitions, and securities also, would sort of have conflict of interest. To protect that conflict of interest, there is a barrier created, which is not the actual wall which you can see, but it's sort of a protocol which doesn't allow you to communicate between two departments, the investment banking department and the equity research department. Going on to the valuations, the part 2 is basically focusing on the valuations. Somebody asked a question about valuations before, so I just thought would touch on that part also. Value of a company is essentially the cash flows which the company is expected to generate in future, and the growth which it is expected to deliver in future, discounted that to today's valuation would give the value of a company. The approaches to valuation are essentially on the DCF methodology or relative valuation, which is considered to be the fundamental valuation type per se, and then the other one, the other valuation approaches which are commonly followed in trends-driven market are the technical analysis. So if a chart is being presented to you and says that buy on dips and buy on sell on stop loss and all those things, those terms are essentially the technical valuation. That is not what a fundamental analyst does. Fundamental analyst researches the companies, its business products, its portfolio, its management, attitude of the management, how they are sort of, are they very aggressive, or they're the true leaders, they run after the growth or what. So that's the reason why fundamental analysis is considered superior to technical analysis. While selecting a security, there are a variety of approaches to follow. One would be the top-down approach, wherein you decide upon a country. For example, we will decide 10 countries. For example, India is growing at, say, 7%. Or the countries which are growing at above 7% is the target. Then you will shortlist those countries and then invest in those countries. After deciding the country, you would arrive at the sector. Which sectors are sort of expected to perform, be it technology, food and beverages, the consumer-driven sectors, for example, or education, whatever it may be. So you then percolate it down to the sector and then possibly to the companies, who are the better performing companies within that sector, and invest it that way. Whereas the bottom-up approach essentially starts with a company and then ends up with probably the country, meaning which country to go for. The fundamental analysis, DCF methodology, is essentially, as I said, it's the future cash flow discounted to today's level. So it's the year zero, what is the value of future companies' future cash flows discounted to today. Yeah, so this is a methodology explained in detail. If somebody is interested, keen to sort of know the methodology, I will be able to share this presentation after the thing. So this is a detailed description of how the valuation happens. You have the annual cash flows of the firm determined, operating cash flows minus taxes, difference between capital expenditure and depreciation and change in working capital, which is used to arrive at the future cash flows of the firm. And then those are discounted back to today's rate using the variety of rates. It may be cost of equity or cost of firm. So there are two approaches to value that way. Dividend discounting model is essentially focuses on the dividend paying companies. So all the companies who pay high amount of earnings via dividends are valued using the DDM model. So further insights on the CAPM. CAPM is the capital asset pricing model, which uses the market risk as well as the firm specific risk factors to arrive at the discount rates, which are used to discount the future cash flows of the firm to today's value. So this is an example wherein we are valuing SAB Miller, which is the largest sort of beer company, one of the largest beer companies in the world. It's probably second largest now. So you have the cash flows in the top line of the chart. So if you see that there are the discount factors, then the cash flows, the theoretical tax rates, and arrived at the final post-tax cash flows, which are again adjusted to the capital expenditure and depreciation to arrive at the sustainable cash flows for next 10 years. And after the 10 years, you would sort of obviously focus on the long-term growth rate expected for the company, which is stable rate, which is not the sort of fixed, which is the fixed rate, and then you arrive at the valuation. So sum of the parts valuation is one more method which we use quite frequently, wherein you value certain assets at different rates with different growth rates, and the certain others at the other rates. Moving back to the relative valuation, relative valuations is essentially driven by sort of value the other firms command in the industry. So it's basically the private the PE multiples or the EV EBITDA multiples. And in addition to that, you also compare the characteristics of the management and other comparable things. Yeah, relative valuation masked as DCF. So relative valuation, which considers the fundamental values more than the pure DCF methodology, is considered as relative valuation, which is masked as DCF. What is P ratio? Anybody? Yeah, large answer. So everybody knows it. And yeah, while valuing, you consider two factors. It's a trailing P or forward P. Forward P is the forward-looking earnings of the firm and calculated P ratio with that. Whereas the trailing P is the past 12 months preceding the date of recommendation. Relative valuation multiples, part 2, is the other most important ratio which is widely used by the industries, is the EV/EBITDA multiple, which actually shows, which is the proxy to the enterprise value and the EBITDA calculation. EBITDA is the proxy to the annual cash flows which the firm generates. So historical trend has been that the low P stocks have always given higher returns. So invest in value firms. That's the message. These are some of the charts which shows which we use to sort of forecast the forward-looking P multiples or sort of see where the trends are going. So this is one more sort of comparison of, for example, the company in the center called Coca-Cola Hellenic is compared with other sort of bottling or soft drinks companies, Pepsi, Coca-Cola Enterprises, as well as Pepsi Americas. And then the premium as well as discount is calculated. So this is probably too small to you for you to view, but this gives the sort of expected growth rate and standard deviation of returns in the past, and the PEG ratio, P ratio divided by growth. PEG is the ideal indicator to value a company or compare a company based on the relative valuation multiples. The other multiples used are the price to book value, price to sales, and sector-specific multiples like price to sort of, for example, the telecom sector would be sort of average revenue per user is a sort of quite common methodology used for valuing telecom companies. So this is again one more sort of picture which shows the valuation multiples for the beverages sector per se. So these are the sort of templates maintained by all the banking professionals or the investment banking professionals to value the companies and keep a track of it. These are updated on a daily basis. So this is an example of widely used multiples. Cyclical manufacturing companies will obviously go for relative PE multiple or a pure PE multiple. Apart from that, for example, banking companies would usually use the price to book value multiple. Retailing price to sales is quite common indicator. Defensive sectors would obviously go for EV by EBITDA or PE multiple. So while doing M&As, mergers, acquisitions, what sort of analysis you do? This is essentially not different than what an equity research analyst does. It's the same. The only thing is the focus is more on the multiples and the business fundamentals and the valuation essentially. So how that and the synergies basically. So how acquiring a company would sort of synergize the existing nature of the company going forward. So that is being the key focus of the M&A. 1 + 1 is not equal to 2. It's more than 2. That's it. I think, yeah, it was a long sort of purely academic discussion.